What's up, everyone? It's Scotty with MoneyVest. Welcome on board for another Market Open live stream. We've got CPI numbers, inflation numbers coming out for the month of October in the United States in under 30 minutes now. So at 8:30 a.m. Eastern, we've got the CPI numbers. I want to hear from all of you in the chat. First of all, if you guys can hear me, see me, just give me a thumbs up. Just want to make sure the audio and the video is working well. Drop a like, share this live stream with other folks who might be interested in joining, and of course, taking a look at inflation numbers and the market's reaction live to those CPI numbers as well. So first of all, let me know in the comment section down below if audio video is good, and then we will get this party started. So good morning, everyone. So again, thank you so much for joining and spending the early morning here with us. So today's CPI, tomorrow is going to be PPI numbers, so producer price index. Tomorrow we're also going to be doing a live stream to break down some of these numbers. And this right here is the consensus. We've got a poll going on in the live chat as well, so make sure that you do participate. We're gonna look for at least 400-500 votes before the CPI numbers come out, so we can get a good data point and good data set. We've got lots of data to break down. I'm super excited for this, and I really hope you guys are pumped as well. So I can already see overall saying go Bears. We'll do a poll after this as well between bulls and bears, and we'll kind of see where everyone is positioned and what the consensus looks like in terms of market direction as well. So perfect. Audio, video, good. And we are ready. So CPI consensus for the month of October, 0.1% on a month-over-month basis for headline CPI. And year over year, we're expected to come down dramatically down to 3.3%. That's going to be down from 3.7%. And then core is really where the focus needs to be, because that's really what the Federal Reserve is also watching. Month over month is going to be 0.3% increase. And on a year over year basis, we're looking at 4.1%. Which is going to be stable from previous months. So not a lot of change expected on a year-over-year basis. Now, this right here is going to be my expectations. It is very clear, and I think it's very obvious. If we come in line with expectations, of course, that's going to be very neutral for the market. In other words, the market reaction may not be pretty substantial in either direction. But, of course, if we come in higher than 4.1% on a year-over-year basis. In other words, if we accelerate back higher from the previous month, and headline CPI also comes in a little bit higher than 3.3%, then that may not be very well received from the market and could end up being bearish from a market reaction standpoint. And of course, if month over month we also come in hotter than what the expectations are, that will continue to kind of reaffirm some of those concerns that inflation is being a little bit more sticky and more persistent in the U.S. economy. Now, if the numbers come in better than what the expectations are, so that's pretty obvious. If you're under 4.1%, if you're under 3.3%, month over month, if you come in better than expectations at less than 0.3 and less than 0.1%, especially headline. If headline comes in at 0.0%, basically no change or deflation, that's actually going to be very bullish for the market. And if we dip below 4% on core, that will also be incredibly bullish for the market. I could easily see the NASDAQ, S&P kind of reacting very positively to that print, and potentially be up 1.5, close to even 2%. On cheering on those inflation numbers. So those are going to be some of the expectations in terms of bullish, neutral, and bearish numbers. And this right here is going to be trueflation, which they are suggesting that year over year, we're already sitting at under 3%, and the U.S. government reported rate is 3.7. So 3.7 obviously was the previous number for the month of September, but trueflation is saying, or basically is assuming, that the real rate on a year-over-year basis is 2.92%, which again, there's some speculation, there's some concerns, there's some estimates that shelter prices are rolling over. Used car Manheim index has been coming down. Food prices have been rolling over. So there is disinflation on shelter and food. There's deflation, or at least there was deflation in energy. But in September, we did see energy prices kind of revert back higher to 0%. So we were in significant inflation, then we came back down to deflation, and then now we're rotating back lower. However, in the month of October, energy prices were down a little bit over 10%. So crude oil prices selling off. So I wouldn't be surprised if once again we see that decline in energy prices in the month of October. However, trueflation does suggest that we are already sitting at sub 3%, which of course the US government rate is much higher. Now this right here is Goldman Sachs predictions for markets reaction in terms of where we end up for core month over month. So in other words, if we come in less than 0.1 less than 0.15% to be precise. The expectations right now are 0.3. So if we come in less than 0.15, which is going to be a very, very good print, it's going to be better than what the expectations are. Then the S&P could potentially see a plus 1% move to the upside. If we come in somewhere between 0.15 and 0.25, that's going to be, again, somewhat better than what the expectations are, because expectations are at 0.3% for core on a month-over-month basis. That means a 75 basis point potential rally for the market. And if we come in between 0.25 and 0.35, we're going to be in line with what the expectations are. And in that scenario, they're expecting the markets to be higher, S&P to be up 30 basis points. And if we come in hotter than what the consensus is at 0.35% or higher, then the markets can be down anywhere between 0.5% to as much as 1.5% in case month over month we see a pretty substantial jump of 0.5% or higher on core inflation, which is excluding for food and energy. So, these are very, very precise. I doubt the market's going to be reacting in these certain things at certain levels. I think, it's much better for us to just simply look at, okay, whether that's going to be bearish, neutral, or bullish in case we come in hotter or better than what the expectations are versus if we come in neutral. So this is what I'm basing it off of, right? So again, the percentage move is going to be somewhat unpredictable and how the market's reaction might be after the CPI numbers come out. So this is very precise. I doubt the market's going to follow exactly this to the T, but yes, if we come in hotter, then the market's not going to like that. If you come in better or softer, then I think that's going to be very well received. Now, this right here is Bank of America Fund Manager Survey as well, which is what I want to break down. So 76%, according to this Global Fund Manager Survey. By the way, a lot of fund managers participate in the Bank of America Global Research Survey. We're looking at over 3,000 fund managers, portfolio managers from all over the world participating in this survey. So, it's also like I would take it with a grain of salt, because what people say is not exactly what people do, right? It's really the actions speaks louder than words. So what they may put down in a survey or what their expectations are may not necessarily be is what exactly they're doing or positioning their portfolios. I would take that with a grain of salt, but 76% do say that the hiking cycle is indeed over. 80% expect lower short rates in the future, and record 61% expect lower yields, and just 6% see higher CPI in 2024. So in other words, 94% of hedge fund managers expect CPI to be lower than where it is today in 2024. And they're also expecting, they're over 60 to 70%, they're expecting lower long-term rates. In other words, they're expecting lower yields moving forward. That's exactly where my bet is on TMF. Of course, we'll find out if the yields eventually start rolling over or not. But this is really where majority of the consensus is now starting to be. And this is also represented in this chart, which basically mentions how the fund manager survey shows investors were dumping cash to hold the biggest overweight position in bonds since 2009. And we know the bond market has had its worst sell-off in over 200 plus years. And this has been the sort of like one of the longest bear markets for bonds. And the 60-40 portfolio has seen its worst performance in a very long time, because the bonds have been underperforming significantly as yields have continued to go higher. Interest rates are at their highest levels in over 16, 17 years. And as a result, the overweight in bond market makes a lot of sense, but there is two forces at play, which I talked about in one of my other videos, that on one hand, you've got, the refunding program, you've got the Treasury Department printing like there's no tomorrow. And on the other hand, you've got the hedge funds continuing to short the bond market, which if they do start covering, it's going to create an upshot on the prices, lower yields. But then if there's continued imbalance with supply and demand, with the Treasury Department continue to fund their deficits with new issuance, then there's going to be more supply, driving prices lower, yields back higher. So there's two forces at play going at each other at the same time. And as a result, there's a lot of bond volatility at the moment as well. Now, UBS also sees a raft of Fed rate cuts next year on the back of a U.S. recession. So U.S. recession probabilities have continued to get pushed further and further back. Earlier, it was in 2022, then 2023, and 2023 came and went. We're almost done with the year, and now it's getting pushed back to 2024. So UBS expects the U.S. Federal Reserve to cut interest rates by as much as 275 basis points. It's like 2.75%. That's going to be close to 4.48 plus 3. We're looking at 11 rate cuts. 11. That is insane. 11 rate cuts is what the UBS team is expecting from the Federal Reserve, almost 4 times the market consensus as the world's largest economy tips into recession. And in its 2024-2026 outlook for the U.S. economy, they're expecting the economic resilience through 2023 And then many of the same headwinds will turn into risks. And meanwhile, the bank's economists suggested the fewer of these supports for growth rate that enabled in 2023 to overcome those obstacles will continue in 2024 as well. And they're expecting disinflation and rising unemployment to weaken economic output in 2024. And that's really what it comes down to, right? At the end of the day, it's going to be very much focused on where unemployment ends up going. That's the most important driving factor and the key leading indicator for any economy. It doesn't matter whether it's the US or Europe or Asia. Every economy depends on how many people are employed. If the unemployment rate starts to go up, that's going to be a bigger problem. And I did a complete analysis on the labor market as well. Surprisingly enough, 80% of the workforce in the US is employed by, what do you think? What do you think? I want to hear from you guys. I want to hear more engagement, and of course, definitely see if you guys kind of remember what we talked about. So 80% of the workforce in the U.S. is employed by which type of companies? Which type of companies are basically employing over 80% of the workforce in the U.S.? Let's see who's actually going to get this answer. And extra brownie points for people who can get it right. But, we talked about the state of the labor market in one of our previous videos, and I want to hear from all of you. And definitely do participate in the chat and let me know if you remember where majority of the workforce is coming from when it comes to the labor market. So SME, perfect. Small, medium businesses, that's exactly right. It's not big tech, it's not large cap. And also, not only are there small, medium businesses, but it's also private companies, right? So yes, Ray mentioned private. So it's small, medium businesses, and it's also private companies as well, for which we don't have a lot of data with respect to how well they're doing. I'm actually working on another research report going over the Russell 2000. As we know that, over 500 companies, or I think a little bit over 30% of the Russell 2000 is not profitable and is in negative cash flows. So they're not all going to survive this downturn with higher interest rates and a potential for recession. But eventually, we're going to have to look at the labor market, the strength of the labor market. And if that starts to weaken, well, then that's going to be the first most important leading indicator for potential recession. Because once people start losing their jobs, delinquency rates start to go up. Another really important factor to look at is credit card delinquencies, right? They're still, lower than where we were in the past. So if I come over to delinquency rates on credit cards, we're still under 3%. So we're at 2.77%, as you can see over here. But the important thing to note here is that we're on the rise. You can see that we have been, pushing higher since the third quarter of 21. And this is exactly the time when the Federal Reserve also starting raising interest rates. And we're now at 2.77. So going from 1.5 to almost 3, this index has already, doubled. And it's really just, getting up to over 4.6, 4.7 is when things will start to become a little bit more interesting. We're already higher than the pre-pandemic levels of 2.66%, right? Before this started to go down because there was a lot of, influx of quantitative easing, a lot of pandemic checks, stimulus checks, which kind of definitely spiked that savings rate among people. And now it's starting to go back higher. And it's higher than in 2011, right? So since 2011, it's the highest we've ever seen. So some things to keep in mind, of course, labor market's really going to be the one that dictates where the economy goes. By the way, guys, make sure that you drop a like. I would really appreciate it. Over 300 people watching right now. I want to see at least 300 votes participating on the core CPI. What do you expect? Is it going to be higher, lower, in line with expectations? And also drop a like. I would really appreciate that as well. And it'll help push this live stream out to other folks as well. Okay, services, hospitality, yep, so small, medium businesses, government sector, and mostly private companies as well. Construction, and then we got buying another share of SoFi. If you get it right, yes, we'll continue to buy SoFi if you guys get the questions correct that we're asking here. But let's take a look at the market. So QQQs are up over 25 basis points. We got the SPY up over 12 basis points, and the Dow Jones here very, very flat. Everyone's just waiting for those inflation numbers with the 10-year yields sitting at just over 4.6%, and volatility is sitting at 14.8. So we are once again at reasonably low levels, not exactly at the lowest percentiles, but we are low. And this is the spreadsheet that I definitely want to help you guys understand better. I talked about this in more detail in our market update video from yesterday, but this is, in my opinion, going to be very, very useful data. It may not, be super useful like every single day, but it's usually the tail events that we're trying to catch, right? So tail events are lower upper tail in that bell curve, and we look at statistics, is what we're really trying to catch, because that's where majority of the money is made, right? Majority of the money is made when either the sky's falling apart, there's recession, there's bear markets, or there's a significant amount of euphoria and there's a bubble that's currently being formed, right? So those are the two sort of extremes where historically, we've seen the majority of the money is made. With the decisions we make in those tail events is what makes all the difference when it comes to our investing success. And these charts, these tables basically show us that, right? The RSI reads, the volatility summary, the market breadth with respect to the S&P 500 20 SMA, the NASDAQ 200 SMA, the S&P 500 valuation, and of course, total assets in money market funds. There will be more and more spreadsheets and data points added over time. But right now, you'll notice the current read on the S&P RSI is 68.1.8, 71st percentile. We're very, very normal. We're slightly higher than the average and the median over the last 90 plus years, but we're nowhere near close to these red areas where as soon as we cross over 70, we will get to over 90th percentile or higher for S&P 500 technical reading. And that's where we have to be a little bit more cautious. That's why it's getting red as you go farther up, and it's getting greener as you go farther down, because that's where the market's going to be very, very oversold. And technically speaking, it's going to be a better opportunity for us to take advantage of that. 1 second, I got to take this call. I am going to put you guys on pause. I'm so sorry. It's an important call here. Just 1 minute. All right, guys, sorry about that. So as I was saying, the lower we go, the better it's going to be from a technical analysis standpoint, because that's going to be lower RSI reading. Market breadth is going to be offering some pretty good risk-reward trade-offs. And of course, we're also keeping track of volatility. Right now, we're in the 30th percentile and nowhere near close to 23 or 24 yet. But again, the lower we get, the better the deals are going to be. Volatility works in opposite, right? So the lower we are, the more cautious and concerned we need to be, versus if you're higher, then it's going to be good deals and good opportunities. Anyway, so I'm going to go over some of the comments here. We've got, less than 12, 13 minutes for the CPI numbers to come out. So let's see. Is Upstart a good buy for medium to long term? Cool is asking. So I'll do a video on Upstart, but I think they're struggling with profitability right now. So that is something to keep in mind. They've obviously been selling off quite a bit. Once again, they had a very strong rally, a little bit of short squeeze because Upstart was also one of the most shorted stocks. Went up almost 500% and then dropped right back down 70%. This is probably one of the most volatile stocks out there. And we've got a huge gap to fill, which of course Upstart dropped after the earnings. Resistance is going to stay put at $22 with the support sitting roughly at $12 for the company as well. Palmet says CPI leaked. Hot CPI, we lose short term, and going into 2024, all lower CPI does is provide the markets to only run in the short term and shows that things are slowing down. Bearish 2024 as well is what Frank is saying. Srinivas, hi Kadi, how are you doing? How's the weather in Dubai? When are you planning to come to Florida? So Dubai is good. Weather is really hot still. It is cooling down though a little bit in the evenings and the mornings, but overall things are going well. So Frank, that's an interesting take on the overall market. So I think it really just is going to come down to how well the economy holds up under higher interest rates. The Federal Reserve, as I've already mentioned, they are focusing very much on inflation. They're not going to care about whether the economy is in recession or not. Now, to what extent is Jerome Powell going to be tough on that regard is still yet to be seen, because it's one thing that you can talk tough, but if there is a recession, what are you going to actually do is a whole different story. In the past, we've learned, Paul Volcker and some of the other Federal Reserve chairmen, what they have done is that when interest rates were higher and the economy ended up being in a recession, they prioritized fighting recession more than fighting inflation, even though inflation was coming down. But during recession, what they did was lower interest rates once again down to really, really low levels. And what that did was, yes, support the economy with quantitative easing, but that once again reignited or reaccelerated that inflation back higher in a more significant manner. So that is not something, in my opinion, that Jerome Powell wants to repeat. In other words, that's not a mistake that they want to do again. He's mentioned that time and time again. And for that very reason, I'm kind of convinced that even if the economy weakens into 2024, if inflation doesn't come down, then I think the fight or the battle to bring inflation down is going to continue, which in a recessionary environment is only going to get better. In other words, if there is a recession, people are just in general not going to spend as much on discretionary items, and shifting is going to shift very much towards defensives and necessities, and that's going to lower prices on its own, and bring that supply demand back in balance, back in equilibrium a little bit better, a little bit faster. So it's not like recession is a prerequisite to bringing inflation down, but yes, recession is a kind of like a collateral damage that ends up happening with bringing inflation down. But if we do see one, that also does help inflation coming down eventually. So, 2024 is going to be quite an interesting year, given that interest rates are still a big question mark, and not to mention that unemployment is going to be driving a lot of the things as well. So Angela's asking 11 rate cuts from what dates? Sorry, missed that. So they're expecting for 2024, 11 rate cuts. That's pretty significant because we don't even have that many meetings in a year for the Federal Reserve. So they're definitely expecting, 2 or more rate hikes per meeting for interest rates from the Federal Reserve. But they are expecting, starting in 2024, they're expecting, 11 rate cuts. In other words, 275 basis point cuts in 2024. That's, a little over 4 times what the market's pricing in, because if you come over to the Fed Watch tool, again, you'll notice the market's only pricing in 3. And this number is also increased from 2. And the markets are definitely still with the discrepancy with respect to the Federal Reserve as well. We've got one last meeting this year. So at the end of 2023, so in less than a month, we've got the next FOMC meeting, and we've also got the summary of economic projections coming out on that same day, and that's going to tell us a little bit more about what 2024 and 2025 looks like. But yeah, markets expecting a pause, no more hikes, and the Federal Reserve continues to talk a little bit more hawkishly, suggesting that there is going to be one more potential hike. Anyway, so 8 more minutes. 8 minutes left. Markets are starting to rotate back higher a little bit. So yields are slightly down about 0.5%. I want to see a lot more votes. We got 279 votes right now. I'm sure we can get up to at least 400 votes. So make sure they do participate. It's a pretty split vote right now. There's not a lot of majority in any particular option. So 35%, a third of you expecting core CPI to come in higher than 4.1% year over year, 37% expecting less than 4.1%, and then 27% expecting at 4.1% for CPI. So there's not a lot of majority in any of the options here. So if economy were physics, we could have easily predicted a recession. Yeah, so that's the thing, right? It's not perfect science. It is a very, very interesting sort of discipline. Economics is definitely very interesting in a way that there's so many variables at play, and there's a lot of dependency on market behavior, on human behavior, on how people respond to certain things, on how we spend, how we save, how we invest. There's a lot of components that are involved in our decision making, and which on an aggregate basis is what really makes the economy. So yeah, it's not an easy thing to really extrapolate all the data points and make sense. That's why, one of the things that I've kind of mentioned and something that I live by is to not even focus on making predictions, right? Forecasters, economists, what they do is they try to make predictions. I think it's a lot better in trying to assess the current situation and trying to assess and evaluate the today instead of trying to predict the tomorrow, because the latter is something that is useless. I mean, Peter Lynch mentioned if you spend 13 minutes trying to predict what's going to happen, you wasted over 11 minutes. And that's so true, because it's useless, right? Okay. Any market moving events tomorrow? Yes, so we do have the PPI numbers coming out tomorrow. Cool. Joey, Caddy, did you get a new Discord? Nope, so it's the same Discord. You can access everything through our link in the description and in the comment section down below as well. You get Discord access, 20 plus channels, including trade alerts, trade ideas, everything's included, and as well as spreadsheets, which I think is probably one of the most useful things, is access to our intrinsic values, debt calculators, retirement calculators, and our volatility spreadsheet, S&P 500 valuations, different market breadth and technical indicators. We're spending a lot of time putting together this data for everyone that you can access all these different tabs. And it's really going to be the super useful part is when the markets actually start dropping. When you start to see the next tail event, which is the next bear market, the next recession, that's when this is going to be the most useful because it's very data driven and kind of helps us understand historically, we're going over 67 years, 91 years, 100 plus years on a lot of these analysis to better understand how markets responded to those time periods to better make decisions moving forward. So yeah, it's the same thing. It's just going to be the link down below. Okay, 5 minutes, and I want to see at least 400 votes. We're at 334. Come on, 66 votes left. Make sure that you do participate so we can get a good data set. And also do drop a like on this live stream. I would really appreciate that as well. Energy has been going down. This should hopefully help cool things a bit. Yep, so energy prices, we talked about it in our yesterday's market update, was down a little bit over 10%, which certainly is going to help this inflation print. And I will do a video on Trade Desk as well, Srinivas. So we'll be talking about that company in more detail in one of our separate videos. But right now, I think the focus needs to be on inflation. So CPI numbers coming out in 4 minutes. 4 minutes. I'll do an audio check and also make sure that you do participate. 50 more votes. 50 more votes. I'm sure we can get there. We've got 3 more minutes left. So who's ready? Type 1 in the chat if you are absolutely pumped for these CPI numbers. 1 in the chat. Just 1, the number 1 in the chat if you are super excited for the CPI numbers coming out in now under 4 minutes. So let's see. And 2 if you don't really care. 2 if you don't care. 1 if you're super excited and pumped for these CPI numbers. I want to see how many ones can we get? How many ones can we get? Type in 1 in the chat if you're super excited and pumped for these CPI numbers. 3 more minutes now. Oh, Kevin says 2. Really? You don't care? Come on, Kevin. Don't be such a Debbie Downer here. Ian's also doesn't care. Lots of 1s. We got 7s. Lee says -3. Okay, so we do have a lot of 1s, but few 2s as well. Interesting. But yeah, so we'll do an audio check here very quickly. And hopefully everything is working well. So let's just see here. I'm going to pop this out. All right, so we're going to put the QQQs here, SPY on this side, and we'll put the 10-year yield is behind me. So right behind me is going to be the 10-year yield. All right, 2 more minutes. 2 more minutes, folks. This is it. This is the most important data point. So lots of 1s. I love it. All right, 9 more votes to get to 400. I'm sure we can do that. 9 more. Definitely do vote if you haven't already and drop a like so this live stream can be pushed out with the algorithm to more and more people. And we are ready to take a look at what CPI numbers look like. So S&P 500 is going to be here, the bottom right. We've got QQQs on the top right. And of course, I've got the BLS website open here. We'll see CPI items rises, whatever number in the month of October on the back of what is going to be the main culprit for the increase in CPI. Gotta be a hot reading, Lal says. So we'll find out in a minute 10. Minute 10. All right, I'm going to do an audio check. We'll put on CNBC here.
But
Anyway. Yeah. Coming up, breaking inflation data. October CPI is next when Scott Fox returns.
Okay. 15 seconds. We'll see the market's reaction.
CPI.com.
One more look while we have time at the futures ahead of the CPI number, the October number, which is be here in about 10 seconds. You see the Dow has turned marginally positive. It's up a little. It was down earlier. NASDAQ's been the strongest today.
What a
Get
pump.
to Rick Santelli standing
What a
by
pump.
with the numbers. Hey, Rick.
What is going on?
Hi, good morning. Yes, October read on our consumer price index. Month over month headline expected up 1/10 comes in at 0, unchanged 0, which equals the lowest we've seen on this metric since we hit our high at 1.2. That was in June of 22. That was the highest since 05. So 0 ties. That's the lowest we've been. And if you strip out the all-important food and energy, it's up 2/10. That's 1/10 cooler both than expectations and the rear view mirror. Year over year headline up 3.2%, 1/10 lighter than expectations, 0.5% less than the 3.7 look last time. 3.2, just to put a face on it. 3.0 in June of this year was the lowest since March of 21, so we're still above that level. And finally, what I would consider potentially the most important, even though it's ex-food and energy, is year over year CPI, 4%. 1/10 lighter than we were expecting, 1/10 lighter than our last look, which was 4.1. And the metric there, and this is a biggie, we haven't been under 4% since May of 2021. Yes, under 4% since May of 2021. Although this is the lowest level since 6.6, which was a high watermark in September of last year. Now, if you look at the markets, interest rates have moved down. We moved from basically 461 in 10s down to its current level at 447, which equals our intraday low test that we had last week. So you want to pay particularly close attention. And the pre-opening Dow futures have moved higher as well, dramatically higher as well, like 300 points higher as well. So this number is being taken as a good sign, and I understand why, especially if you look at the month over month and you start interpolating out. But I will still leave us all with the notion that 4% year over year, X, very important food and energy. And by the way, all these stories about EVs and power grids and losses on transition, they're not going away. These numbers for energy and pockets of energy are going to stay firm. But that is the number I think is important. All the metrics have moved lower. And as I said, even though all of these have moved lower, they haven't really taken out, other than the headline equaling the lowest level since our high water mark. The others still are comping above levels that were lower. The 3.2 is obviously good news, but as I said, it was 3% in June. We want to pay more attention to how this transitions into the actual opening, but we'll toss it back to the panel to debate some of these numbers. Joe, back to you.
Yeah, immediate reactions, though, and pretty big, bigger than we've seen recently. Stay with us. Let's bring in our senior economics reporter, Steve Leisman, along with Joe Livornia, chief economist at SMBC Nikko Securities, and Kitty Richards, a former Treasury Department official under President Biden, also served as an economic advisor to the president when he was vice president. Steve, we'll go to you first. And I think one of the things Rick said was that 4.5 we saw has been breached on the downside for the 10-year. So that sort of, I don't know, that's kind of like a confirmation of that move maybe at this time because of the CPI number.
Yeah, I think that's right, Joe. There has not been a lot of inflation in the move up in interest rates, and it's interesting to see some move down in it. It's not quite there yet, but we're still quite a bit above financial conditions being tighter. But this is a good report. There were some surprises to the downside, and it's been a bit since we've had surprises to the downside. We're incrementally making progress towards the Fed's goals here. One of the big standouts here was the owner's equivalent rent, which is the proxy for housing, down to 0.4% after 0.6, surprising to the upside in the prior month. You got gas down 5%. That's headline stuff, not really a big issue. Used cars down 0.8. That's a big number there. Physician services also down 1%, while hospital services were up. And just one quick, Airline fares down 0.9%, so that probably comes along a way that energy seeps into the service sector. So I think that if you were to draw, let's say the Fed was equidistant here between hiking and not hiking, this is an incremental move towards not hiking again. So I think the market likes it that way, Joe.
Yeah, and Livornia, I guess you just say the Fed's been too tight, and this is exactly what you said was going to happen, right?
I did. Joe, the thing about it is if you look at the headline inflation rate, it peaked in June of 22, and core CPI peaked in September of 22. That was way before monetary policy got anywhere near restrictive. So if this economy slows, and it is, then this inflation pressure should moderate even more going forward. So this is good news. The trend in headline is important because the Fed looks at inflation expectations, so that flat reading that takes that year-over-year rate down close to 3% is very powerful. I don't expect the Fed to hike anymore, and do expect them to be cutting next year.
So, Kitty, this is good news on inflation. Does it indicate that in an election year we might have something that might not be ideal in terms of economic conditions, or you think it'll be just right leading up to November?
Well, what I'd really like to focus on is getting beyond the numbers. So what Joe said a moment ago, I couldn't agree more. If you look at the path of inflation, we have had rapid disinflation after a peak that was, as he pointed out, before the Fed's interest rate hikes really got going. And we've had that rapid disinflation in the context of a booming economy. Quarterly GDP growth last quarter in real terms was 4.9%. We've seen 21 straight months of unemployment below 4%, something many economists didn't think would be possible. But even today's CPI numbers, as good as they are hiding an even better picture. And that's because of the role that housing inflation plays in the way that we measure the CPI. So if you think about the path of real housing inflation, as opposed to the inflation that's measured by the CPI, by the Bureau of Labor Statistics, we've actually seen rental prices and rental inflation peak much, much sooner than even the CPI would indicate. So this month's 0.4% is a drop in shelter, but it is the entire driver of core inflation going in the month over month. And it reflects prices for rent from about a year ago. And if you look at market indices of rental inflation, it normalized year over year several months ago, and in fact peaked well before, on a month over month basis, started hiking interest rates.
Folks, get your rocket ships ready. Get your rocket ships ready. This was such an amazing print. We had shelter prices only up 0.3%. That's a huge win. Food prices continue to see disinflation to a point where we're very, very close to seeing deflation in food prices as well. Energy prices did drop as expected because oil prices were lower, over 10.3% on a month-over-month basis, and as a result, the beats on all four fronts: 0.0% month-over-month, 3.2% year-over-year for headline, month-over-month in core 0.2%, and year-over-year 4%. This was literally, if you come over to our screenshots here, this was what I mentioned before the numbers came out. We talked about this, expectations, and bullish was going to be core under 4.1% year over year. Where did we end up? 4%. CPI less than 3.3%. Where did we end up? 3.2. Core less than 0.3%. What did we get? 0.2. And CPI month over month headline 0.1% or lower. Where did we come in? 0.0%. Literally no change. So beats on every single metric versus the consensus, and this, very well received by the market as expected, bullish reaction. So good numbers. Shelter prices only 0.3%. Month over month, year over year, we're now coming down from 7.2 to 6.7. Used car prices down 7.1%. New vehicles also down 0.1%. And energy was lower. Energy commodities down almost 5%. Gasoline down over 5%. And energy overall down 2.5% with no change in prices on a month over month basis. You can see October, literally nothing. So if you come over to some of the charts on what this looks like, all items rotating back lower to 3.2. Then we've got, could you hold on 1 second? I'm getting another call, really, really important call. I do apologize here. Just give me 1 second. I'll be right back. Hey everyone, sorry about that. It's just yeah, too many calls. But anyway, so coming back over to the markets here, very strong reaction. So we've got the QQQs up over 1.65%. Man, I gotta put my phone on silent, but these are important calls I can't miss. The S&P 500 also up 1.25%. So very, very nice move to the upside. Of course, not to mention a lot of individual, big tech, large cap companies here. Tesla is up a little bit over 4%, and we got the Dow Jones. Not the Dow Jones, but NVIDIA pushing up over 2.3. Apple here at the moment up 1.5. By the way, yields dropping over 3%. So TMF is definitely having quite the day, up over 5%. So 482 is where we are at the moment. So very, very strong move to the upside for the bond market. So TMF pushing up very nicely. TLT is also up a little bit over 1.6%. Now let's take a look at how these probabilities have changed since CPI numbers come out. My guess is the market's going to be super optimistic about potential rate cuts even further. So if you come over, there we go. Look at that. Four rate cuts. 1, 2, 3, 4 rate cuts now priced in from the markets for next year. This just changed just from a few minutes ago. We're seeing from 5.25, 5.5% down to 4.25 and 4.5% is going to be the consensus now moving forward. 4 rate cuts is what the market's pricing in. And what else has changed? I want to hear from all of you. I want to hear more engagement. So what else has changed in this probability analysis from the market? Not only are we getting more potential rate cuts is what the market's pricing in for next year, but what else? I want to see if anyone's noticed what else has changed since before inflation numbers came out. What else has changed? I want to hear from all 500 of you guys in what you think has changed from market's expectation for rate cuts and rates next year. So what do you think? What do you think? You guys are too funny. Yeah, the shorts are going to have to cover the bond short. This is very good for the stock market. Yeah, I mean, like I said, get your rocket ships ready. Bonds lower, no rate hike. So that was already priced in. The market was already expecting no more rate hikes. We were already expecting a pause. But what else do you think the market's repriced here in terms of 2024 and rate hikes and rate cuts? Bonds lower, so rate hike gone, rate hikes, markets are aligned. No, so rate hike was never part of the market's expectation in the first place. What else did the market reprice in this chart right here? In this table, something changed from before. It's a very subtle change. It's a very small change. Let's see. I'm going to give it a few more seconds. Recession. Well, this is not the markets. It's going to be hard for the markets to kind of really pinpoint a recession probability. Early cut, yes. Early cut, that's it. Mistar got it. So basically, before we were expecting June for that timeline for the rate cut, and now the market's pricing in for May. So we basically got preceded by 1 month in terms of rate cut. Like I said, this is very subtle, very small change, but that's really the timeline of rate cuts, right? This also matters because now the market's pricing in not only 4 rate cuts, but they're also pricing in 1 month earlier is when they're going to start cutting interest rates in May of 2024. So that was the change for what the market's pricing in now. So a little bit earlier in rate cuts and more rate cuts is what the market's pricing in now after the inflation numbers coming out. Look at the move. Like, it was such a violent move in the NASDAQ, up over 1%. Volatility is dropping back down to 14 now, so 5% lower. And look, I know the sentiment overall and the overall sort of move is going to be very, very strong on the day, and it's possible that we continue to see some more acceleration intraday, but we still can't ignore the technical overbought levels, and that's really where we are. We're going to end up being even more overbought for a lot of individual stocks such as Apple, Microsoft, Google, AMD, for example. Let's take a look at how much AMD is up. It's up, pushing up another 2%. So, we're going to be a little bit more on the overbought side. And again, I don't want to, we're going to have to enjoy this, but obviously at the same time, understand that we're getting up to overbought levels here for the markets. So, okay. Good night, volatility. Yeah, so VIX is coming down. So the lower we get, the better, the more cautious I think we need to be because when the VIX is low, it is time to go. So we'll continue to pay attention to volatility. PayPal needs to go up 50%, Ed says. Enphase finally fueling up. So let's take a look. Enphase here up over 4.4%. Not bad, back over $82. And PayPal here also pushing up almost 2%. So it is shaping up to be a pretty good Tuesday. So I think it's one of those days where, you gotta be ready here because it is about to be like complete blast off as soon as the market opens at 9:30 a.m. Eastern. As we're going to be gapping up, and then it's going to be a real question of whether we accelerate back to the upside, or we fill in that gap because the markets, when they gap up, it's possible that we do leave a little bit of a gap to come back down and fill in. So that's where we are. Pretty strong inflation numbers. If you have any questions, please feel free to reach out. Leave them in the chat, and I'm happy to look into any specific stocks, kind of explain more about the macros, volatility. And again, if you have any questions, definitely do let me know in the chat. And I'm happy to go over individual stocks, macros, whatever it is that you guys want help with or need more guidance in. But the 10-year treasuries here definitely dropping quite a bit, right? 4.5% we're lower now. Looks like TMF trade is finally going to pay off a little bit, 5.5% higher. But we want to see it back over $5. $5 or higher is really what I'm looking for on TMF. And the next targets all the way up to 550 to as much as 640 as well. Yes, PPI tomorrow. So PPI is going to be coming out tomorrow as well. Also very, very important numbers for producer price index, which I think they're only going to kind of reaffirm what we've already seen with CPI. But these are pretty good numbers, to say the least. I mean, we kind of hit right on the bullish scenario. Everything came in, 0.1% lower than what the expectations were. Literally everything came in at 10 basis points lower than what the consensus was. So, of course, it's going to be a bullish reaction and a very positive reaction from the market. So, Thomas, how do you think the election year affects rate cuts? Well, I think there's going to be more political pressure, but given what we have just seen, I think the Federal Reserve's got an easier job now. The only thing that is going to now matter is whether economic conditions continue to be resilient or if they start to slow down. If they're resilient and inflation's coming down, then that would be a very rare scenario of an actual soft landing from the Fed, where they're able to achieve stronger economy for whatever reason, while also bringing inflation down. So, the Federal Reserve and Jerome Powell also mentioned in the monetary policy discussion that they're very, very surprised on how resilient the economy has been, right? They're very surprised with the resiliency of the economic growth and the spending that continues to be very strong. So they're also just as confused as everybody else, is that how is the economy so strong given how high interest rates are? There's a couple of reasons for it. The labor market's very tight because economies are still, the companies are still well capitalized, and they're still hiring, or they're still keeping employees, on board, because and on the other hand, you've got consumers spending on the back of debt. So, and that's exactly one of the reasons why we've seen, debt levels kind of increase substantially. Credit cards, mortgages, auto loans, everything's been very, very high. So Srinivas, yeah, thank you so much. GPSC and LB looking good as well. NNDM and PSNY, I'll take a look at those as well. So when do markets go lower when the Fed cuts rates? They go lower when the Fed cuts rates when there is what? When there is what? We've talked about this before in our previous videos. In the past, we've drawn those correlations. I've talked about how the Federal Reserve, when they start cutting rates, the markets start going down, because the Federal Reserve's cutting rates when what happens? What is that word? What is that one word? Why? First of all, why would the Federal Reserve cut rates in the first place? Mill says, awesome today. I know, right? It's about to be a party in the Discord. It's about to be like screenshots of greenery, plus this, plus percentage this, plus dollars that. It's going to be all over everywhere. Recession, yes, exactly. When there's recession, that's when the Federal Reserve cuts rates. So if the economy can avoid a recession this time around, and inflation can come down, well, that is the soft landing. That's the definition of a soft landing, is bringing inflation down without causing a recession, which would be rare, which would be kind of unusual. And, we'll have to give credit to the Federal Reserve. I mean, of course, it's a problem that they created, for which they are now building the solution for. So, but that would still be a pretty big accomplishment from the Federal Reserve. Musicful says VIX is going to go down to 0. FOMO day trader is going to get slaughtered, so get ready. Buy highs at low. Volatility is going to get updated here. So if you come over to the VIX summary, let's see if we can get updated here. I think when the market opens is when this is going to... Oh, there we go. It's already updated. Look where we are. We're in the 25th percentile, folks. Don't let this bull rally on the day kind of cloud what's already been proven based on stats here. So we're definitely coming down to low percentiles, and 25th percentile, we're actually under 14. And if you take a look at days spent under 20 for the VIX, is 61.3%, but then days under 10 is only 0.8%. Right? So these are really, really low observations for volatility. So that is something to keep in mind, because another 3-point move lower on the VIX, so if you come down from 13.9 to, let's say, 10 or lower, that is going to be a straight up indicator to be cautious and looking out below, because market breadth suggests we're getting overbought from a technical standpoint. And again, I do know that when I say these things, markets are rallying and everybody wants to enjoy and everyone wants to have a good time because we're very, very green. I totally get that, and I'm 80% long. I'm not shorting the market, but I'm still going to point these things out because they're important, right? So that's something that I will continue to kind of voice some of the concerns from a technical, from a fundamental standpoint, from a market breadth standpoint. So we're good. We're still good. We're still in the normal territory. But the moment this drops under the 20th percentile is when this index will turn into rare, from normal to rare, which means that we need to be cautious. We need to be cautiously optimistic, is what I'm gonna say moving forward. So yeah, that's where we are. Switching back down to 25.4. RSI read is going to probably jump to 65, which would still be normal, but we would be jumping up to 75 percentile, which would still be the normal occurrence. But the higher we go, the more rare it will start to become from a market technical standpoint. Yeah, volatility in RSI, definitely. Some things to really be watching very closely, and these are very, very important indicators. You cannot ignore that. So jobless claims, they're actually still surging up. So they're not surging up per se. So like if you take a look at initial claims, we're still under 300,000. Like we haven't seen jobless claims go up, right? I mean, they're still very, very flat. If you take a look at, where we are, we kind of peaked at around 265, June 17, 2023. Since then, we've just been coming down for jobless claims. So, unless it trades back above 400,000 or at least 300,000, is when I would be a lot more concerned. Like right over here, from 2021, like these levels, is if you go back up to over 300,000 is when we start to expect, okay, unemployment could follow back higher. But right now we're still very, very muted. Every single week we've seen like 200,000, 220, 215, 210. So we're nowhere near close to those levels. So we're really watching 300 or higher for jobless claims, for initial claims. My God, you guys are hilarious. Okay, let's see. Levels to go long on SQQQs. So really, I think it's an analysis on the NASDAQ per se. That's something that I've mentioned, is that whenever you're looking at trading levered ETFs, the technical analysis on those leverage ETFs is rendered useless because there's no like supply demand for those leveraged ETFs. What really matters at that point is the underlying index, right? You're really doing the analysis on the underlying index or ETF that it's tracking. So in the case of SQQQs, you're really doing analysis on the NASDAQ 100 to better understand what's going to be that resistance, where can it get tapped out, so that we can take or look for an opportunity on the short side on SQQQs. So QQQs, for example, they're going to gap up here pretty well, 1.7% on the day. And the next target resistance is going to be 387. That's the same exact level from July highs, right? So we're pretty much back up to July levels, and we're going to potentially accelerate and continue on this momentum back up if we get a breakout. But that resistance is the one to watch. There's going to be a gap to fill. Not to mention we're going to be overbought after today from a technical perspective, and volatility is going to be really low. So can we break out over 387, 386? We could, but the risk reward is certainly not going to be favorable on the long side for the bulls. So just have to be a little bit more cautious here now, considering that the NASDAQ has rallied, a little bit over 12.5% in the last 20 days, the last 1 month, basically. Kenzo says 445 calls, up 400%. That's incredible, man. Congratulations. That's awesome. Does the Fed not cut rates until unemployment gets above 5%? So Tristan, that's a good question. I don't think there's any specific threshold for unemployment that they are particularly watching. Like I said, this time is going to be a little bit different than what we have seen in the past, is because the Federal Reserve's made themselves very clear that they're prioritizing inflation more than they're prioritizing recession or economic weakness or softening the labor market. So I don't think there's any specific number that you can pinpoint to, like if unemployment gets up to over 4%, they're going to start cutting rates. I think it's going to be more of a analysis of where inflation is and how strong the economy ends up being. I still do think that 0% rates are gone for a very long time. Unless there is a very severe deflationary risk. I think that's the only way in the future that we see, interest rates getting cut down to 0%, unless we see very significant deflation risk in the economy. And by deflation, I mean that, prices are going down rapidly. So one of the things that I think it's important to look at is, let's just take a look at Google public data. I want to show one specific thing. All right, let's go here. I'm going to type in CPI. Let's see if it comes up. Let's see. There we go. So this right here is the index for CPI, right? So a lot of people, we look at the year-over-year number, right? And that's very normal. So if you come over to year-over-year, you'll notice that this is the index that's quoted every day. Like the numbers that we just got less than an hour ago, this is the number that we're looking at. We're looking at the year-over-year increase in prices, right? So these are increase in prices from same time last year. Now, one could look at, and this is also, again, I'm not here for political debate, but one could look at and say, oh, inflation's down from 9% to 3.6%. That's incredible. That's great, right? Inflation prices have come down. But no, that's not actually true. The rate of increase has gone down, but prices overall have still increased, and that's represented by the CPI index. And this is what this index looks like, and this is since 1915. So you know how prices of everything is up from several decades ago, right? So gallon of milk, loaf of bread, prices for rent, prices for houses, everything has gone up. The only difference is the rate of increase has fluctuated in the course of how much the prices have gone up. So you can see the incredible parabolic move in prices since 2021. So you can see the index was 260 and now we're sitting at 307. So this incredible increase was due to the quantitative easing from the Federal Reserve and lowering interest rates down significantly, and now it's starting to moderate. So if you zoom in a little bit, you can see that we're going up, right? We're still going up 300, 301, 303, 304, 305, 305, 307. We're still going up, but the rate of increase is slowing down. So unless we see deflation, by deflation I mean the prices are actually going down, right? So this particular index starts to go down, I think that's when we start to see interest rates near 0% again, because again, you can see that 2008 prices were actually going down. This right here was a decline. This right here was a decline, prices declining here. And then of course, since significant increase in overall inflation. So unless there's a deflation risk, I think interest rates are going to stay pretty elevated. We may see it come down to, let's say 2%, 2.5%, kind of settle in around those levels. On a real adjusted basis, they might still be positive. But 0%, close to 0%, I think those days are long gone, at least for the foreseeable future, when it comes to Federal Reserve's interest rate cuts. Okay. But it's Tesla not in the overbought side. So Tesla is actually one of the fewer companies that is not in the overbought territory. I would consider, like, if you take a look at Tesla right now, we're not, in my opinion, at the overbought level at the moment. 30 minutes. So AMD is, Apple is, Amazon is, Microsoft. Microsoft is gonna be like probably one of the most overbought FANG stocks or Magnificent 7 stocks right now. 70 RSI, so is the MACD, like a new all-time high, opening up at 371. AMD, same thing. Nvidia is probably above 500 now, almost at 500. So up another 2.2, coming up to that resistance at 500. It's probably going to be overbought as soon as it opens. And of course, we got Netflix that's also overbought right now with the RSI and the MACD. So there's a lot of Magnificent 7 companies that are going to be opening up with pretty overbought levels. Yeah, negative interest rates we had in Europe. I think there's still negative interest rates in Europe where they're actually paying you to buy a home. It's absolutely crazy concept. I was talking to one of our members the other day in Denmark, and their interest rates are negative right now. They're actually paying people to buy homes. Wouldn't that be nice? Wouldn't that be the dream? Anthony, so what is the number? Is it out? Yes, so numbers are out. Inflation numbers are out. Came in well better than expectations, lower on every single consensus. And as a result, a very bullish reaction from the market with the yields dropping. Look at Tesla. 5% move to the upside here. Absolutely incredible. I really do feel bad for the buyer of the call option. It was such a roller coaster. This was probably the most wild covered call I've ever traded in my options trading career. It was such a wild roller coaster for Tesla over the last 2 months, 3 months actually, since July. I ended up closing it out for, I think, a little over 90% profit, but it was, man, I feel really bad for the buyer because that buyer was in the money for such a long time, for well over 2 months. That buyer was in the money, did not exercise. And then towards the last few weeks, Tesla drops on earnings and price cuts. And then it's now back up. It's now back higher, back over 215. 215 was my strike. Just super volatile, super crazy. Twilio technicals. Let's take a quick look. So let me just go over some individual stocks for you guys. Resistance for Twilio right now is going to stay put roughly around here at $60. Getting a bit more on the overbought side. If it does break out over those moving averages, the next target is going to be 69, and support level is going to turn into $60 per share. So Frank says, Caddy, Qualcomm is the most undervalued AI play in the markets right now. Their forward growth projections do not take into account all the new ARM AI chips for mobile and Windows PC. Peter Lynch special. I do think so as well. Qualcomm, we did a stock analysis on Qualcomm, and I do agree that I think it's trading at a very reasonable to low valuation right now. They're already in partnership with Apple to produce a lot of the 5G technology chips for their smartphones, not to mention the things that you just mentioned with AI. And the multiples are really low for Qualcomm. So it is very much a trade bound in terms of this consolidated pattern with the risk. Basically, the resistance is going to be at 123, 127, with the support level staying put at close to low 100s for Qualcomm. So that really is going to be that support level. And right now we're seeing a lot of consolidation here. So this right here is basically the range within which Qualcomm's been trading for quite some time. But yes, I think I do agree. I think it's got a lot of potential in the future. The only problem is that up until like a few years ago, the revenue was basically flat, right? So it didn't really grow anywhere. And even the last couple of years, the revenues dropped once again, and margins have also come down from 29, 30% back down to 20%. So it's been a little bit inconsistent business. As much as I like Qualcomm as a company and like the fundamentals and everything, it's been a little bit more inconsistent. Tesla, do you still think Tesla will hit 150s? So here's the thing about intrinsic values is intrinsic values are never meant to be taken as price targets, right? There's a huge difference between price targets and intrinsic values. When I say that my intrinsic value is at 136, it doesn't mean that I'm expecting Tesla to get hit at 136, like come down to 136. It's simply a fair value. In other words, what I believe Tesla's true fair value is as of today. And if it gets down to that level, guess what I'm doing? I'm simply buying. If it doesn't, no big deal, right? I still do own Tesla. If it goes higher, great, no problem. So that's the difference between price target and fair value. If I say that I've got a price target of $400 on Tesla, that's when the price target comes in. It's like, okay, I'm expecting the company and the stock to hit those levels in a certain time period, whether it's 1 year, 3 years, 5 years. But if it's a fair value, that simply means that that's what I perceive to be the true value of that business. Is it going to get down there or not is very much dependent on the market, right? The market forces. I have no control over that. I have no control over price target either, but the difference is with price targets, I'm expecting this to play out as the earnings grow, as the revenue grow at a certain percentage. With fair value, it's just the true intrinsic value of that business. So will Tesla hit 150? No idea. I don't know. If it does, that would be coming down to my fair value, and I would love to buy more shares. But if it doesn't, it's no big deal. Still have stocks. We'll be looking at possibly selling some calls today with some pretty good premiums. We'll see how Tesla ends up trading. Okay, in mode, let's take a look. Up 3.3%, so back over $20. This is, in my opinion, one of the more sort of like fairly valued, undervalued stocks in the market. Excellent balance sheet, so there's absolutely no bankruptcy risk, very high margins, significant growth in revenues, but of course down after the earnings revision from the company as well, because again, higher interest rates are hurting in mode as well, because a lot of the things that they sell, large equipments, medical equipment, needs to be financed by a lot of people. Oracle, I think we have done an analysis on Oracle as well. So again, all these intrinsic values are available for everyone that you can access. We've got Oracle over here. Let's see if you actually do have a fair value. I need to update the fair value on Oracle as well. We'll definitely do that after the live stream. There's a few more stocks that I need to update for Oracle, Visa. But again, you can check out this spreadsheet where you can find a lot of the intrinsic value for a lot of the businesses that we're tracking. There's going to be continued updates in this. We're going to end up, this spreadsheet's probably going to end up having like over 1,000 stocks eventually. Of course, it's going to take some time because, it's not easy to analyze over 1,000 companies, but slowly and steadily, we'll kind of continue to build upon the spreadsheet, and it'll be updated every quarter once the companies report their numbers. So that's going to be available with the link down below. Look at the 10-year treasuries, folks. We are on a slide down almost 4% here. TMF rocketing up to 487, up over 6% right now. So Home Depot earnings, I haven't looked at, Kevin. I'll definitely be taking a look at those as well. Let's see how the stock's doing. I did a video on Home Depot earlier, up 3.4%, so very strong move. Looks like beat on EPS, beat on revenue. But we'll take a look at that company earnings here shortly after. Okay. Just 1 second. All right, so planning to sell some TMF today. Not quite. Waiting for 10-year treasuries to drop even further. Really looking for like sub 4% on treasuries. I think that would be very good. Anything under 4%, I think TMF could be in the sixes moving forward. Like that's going to be a pretty sizable move to the upside for TMF, right? 25-30% I think is quite reasonable to expect from TMF if the yields end up under 4%. Let's see how individual stocks are doing. Market's still holding up pretty well. Nasdaq's up 1.69. S&P's up 1.33. The yields continue to fall, and we've got Tesla here up over 5%. Very strong move to the upside. Oil prices just under $80. How's crypto doing? Let's check up on crypto. 36,000 right now for Bitcoin. Ether is just over 2,000. And we do know like a lot of crypto-related stocks are still kind of hovering sideways, not really moving all that much. And volatility is still low. I don't know. How many people actually believe that this rally is going to fade intraday? What do you guys think? Let me just do a quick poll here. Markets today. More green, or let's just say to the moon. We'll put rally fades and basically ends up flat and or an insane sell-off intraday to close red. So the first one's going to be acceleration of this rally to higher levels. In other words, we're going to pretty much go to the moon. The rally fades, meaning that we basically close flat, and then insane sell-off intraday would mean that we would close red. So let us know. Let me know in the comments and in the poll. Next time you put us on hold to take a phone call. No, seriously, guys. If it weren't, I would never pick up the phone on a live stream. It's just that we're working through a few things. I've been, working on obviously a lot of different projects. So a lot of big, exciting stuff coming out in 2024 as we're getting these things built. So just a couple calls that I needed to take. So I'll definitely put on some elevator music or a comedy show in the background while you guys wait. But no, I really do appreciate you guys' patience. So Peter Lynch video, yes, Tesla John, it is already out there. It is on the MoneyVest Reads channel. So if you go to MoneyVest Reads, you should be able to see that on the channel. Definitely do check that out. You know what? Let me just bring that up very quickly. So just give me 1 second. I'm going to go to YouTube and MoneyVest Reads. So yes, we already did that video earlier. So here it is. 6 days ago, posted this. Timeless investing lessons. Peter Lynch's playbook, One Up on Wall Street and Beating the Street. There's timestamps. There's different things to definitely consider. And I would really appreciate it if you guys subscribe to this channel as well. We're trying to get to 1,000 subscribers before the end of this year. So yes, I did post that already. Frank, you need a personal or a virtual assistant. Yes. Pergy says, man, I feel tech is so overpriced. We did a little bit of analysis on the valuation yesterday as well in the market updates. I wouldn't necessarily say that they're overpriced to an extent where it's insanely high. But yes, I mean, if you look at some individual stocks, it's easy to assume that they are overpriced. Like, and again, this is kind of going to piss some people off. But again, if you look at Nvidia, if you look at Tesla, if you look at some of those companies, even Microsoft, I would argue is expensive on a valuation basis. But aggregate, like tech as a whole, maybe not so much, right? 23, 24 times earnings. The PEG ratio is closer to 1.5, 1.6, which on a growth adjusted basis is quite reasonable. But yeah, if you look at some in isolation, some of the companies, then they are certainly on the higher side. Yeah, Peter Lynch, in my opinion, is probably one of the best fund manager of all time. Yeah, and there's a lot of different styles of investing, but one common denominator that I've learned that everyone possesses, Warren Buffett and Peter Lynch and Howard Marks and Charlie Munger and a lot of the people that they exercise is the investment style, which is very much focused on playing defensive. They're really good in playing defense. Because in a lot of the books that I've read, and this will again be covered in the psychology course that I'm building, and also in a lot of our MoneyVest Reads video, is that they don't focus too much on generating higher returns, but the higher focus is on playing very good defense. In other words, losing less money when the markets go down, and that's playing phenomenal defense. And then I think it's a quote from, I forgot who said this, whether it was Peter Lynch or Warren Buffett, but they said that in the markets, you don't have to worry about doing the right thing, but you just have to worry about doing fewer wrong things. And that was just like such a light bulb moment, is because it's very easy, it's much easier to lose money in the markets than it is to make money in the markets. So our goal should always be to play a little bit more defensively. That's why, on the channel, even if you look at my conservative values, they are obviously at most of the times much lower than where the market prices are, because we build that margin of safety, we build that conservative estimates, and sometimes, yes, stock prices can trade significantly lower or higher than what the fair values are, but that's the whole point. Markets are not efficient. If they were, there wouldn't be any opportunities to capitalize on, right? Because markets are so emotional, because there's so much volatility, inefficiencies get created, and that's where the opportunity comes in. So Howard Marks talks about this really well, is that market inefficiencies are the prerequisites for opportunities. Because if they were efficient, everything was getting priced in at the right time, at the right level, then there won't be any opportunities in the first place. So, okay, let's see. So Brian says, today would make a perfect outside day. If you open up, then close lower, that should trap everyone real good. Yeah, that's something to keep in mind, folks. We've got 13 minutes left for the markets to open. Technically, I'm being cautious here. I've mentioned this before in our yesterday's market update as well. We are overbought. Volatility is low. RSI MACD reads are also higher. The market breadth is a little bit more concentrated, so be careful. I know, rallies like today, like Tesla's up 5%, NASDAQ, QQQs, S&P, everything's kind of pushing higher, can be very enticing, and this is very common to trap bulls and kind of attract them, suck liquidity out, and then just literally flood the markets with sellers and shorts and kind of, squeeze this lower. So be very careful intraday, because it's an easy setup for the shorts to trap bulls. So that's why it's important to play, a little bit more on the defensive. Yeah, TMF 490 and pushing. So very nice move here. There we go, 6.75% with the yields dropping lower. So, all right, everyone. So that's going to be it for today. I do have to jump on a call here in 10 minutes. So I really do appreciate everyone. Make sure that you drop a like. See if you can at least get up to 300 likes here on the live stream. We're at 262. So just 38 more likes. I would really appreciate that. And again, links to our Discord and Patreon is going to be down below. If you haven't joined already, it's going to be in the description, and you get access to all the members-only private videos, over 40 plus videos, and Excel spreadsheets, including a lot of the data sets that we're building that I think are going to be super useful for trading decisions, investment research, everything, along with our 20 plus Discord channels, trade ideas, alerts, everything's going to be included. So thank you so much for joining. Inflation coming in super, super good. I would still mention, just cautiously optimistic here. On the day, I know this is very, very strong, so enjoy, but also be aware of the technicals and the market breadth on the day today. So we are a little bit more on the overbought side. So hope you all enjoy it, find it helpful. Make sure that you drop a like, subscribe.